Hello, good afternoon, and welcome to Marcellus's webinar on Rising Giants. This is our mid-cap portfolio. Um, it's been a while since we did this, but happy to report that we've had a decent last 3 months. The portfolio is up about 17%, with the index up about 10%. So good news after a long time. But to give you a sense of what's driving this performance, how the portfolio is performing from a fundamental perspective, we have with us Saurabh Mukherjee, who's our CIO, and Ashwin Shetty, who's the portfolio manager. So without much ado, I'll hand it over to Ashwin and Saurabh to take this forward.
Okay. So thank you, Pramod, and I'll kick off with a sort of quick recap of what's happened. I'm sure many of you remember Rising Giants was launched in the closing months of calendar year 2021. So Jan 22, just to keep it simple. Jan 22, Rising Giants went live. It was the worst possible time to go live, and a lot of that is down to me. I made the wrong decision to take this portfolio live at the height of the post-COVID euphoria. From Jan 22 to March 23, as oil prices doubled and steel prices went up 70-80%, the Federal Reserve hiked rates by 5%. And from Jan 22 to March 23, Rising Giants fell 20%, right? There are not too many fund management houses in the world which will keep their act together when the portfolio corrects 20% in its first 15 months. But we hung in there. We tried to understand what had gone wrong. Part of it was PE rating. Ashwin will take you through the quantum of PE rating. And part of it was there was also a genuine earnings slowdown. As the portfolio demonstrated earnings growth. The earnings growth trajectory was coming down. Then over the last 15 months through FY24 and in the first quarter of F25, Ashwin, our analysts, I put our brains together. We changed some of the things in the portfolio. We brought the portfolio valuations down, increased the earnings growth. And I think as Pramod was highlighting, the result of our efforts to resurrect Rising Giants is it's broadly back to neutral. Some of the clients are actually in the black to a small extent. And most importantly, leaving aside the fact that the stock price went down and it's come up again, that sort of thing can keep happening. Stock prices will yo-yo. Most importantly, the earnings growth piece has recovered very nicely for Rising Giants, both in F24 and in the first quarter of FY25. We are seeing very good indications that the 1Q numbers for the RG stocks will be bumper. Alongside that, I think the election's out of the way. I think it's a good election result. We've got the necessary clarity. I think not just we, the investee companies have the necessary clarity with the BJP back in the saddle in Delhi. The investee companies have the necessary clarity to keep their accelerator down, to keep their foot down on capex. As Ashwin will explain, the RG companies, the investee companies, have done explosive capex through F23 and F24. All the signs are that the capex momentum continues, and thus, if capex continues, by extension, the earnings growth momentum should sustain. We had a good F24 on earnings. Looks like 1Q F25 will also be good on earnings. And looking ahead over the whole fiscal, the earnings growth prospects look the strongest that they've been in the last 3 years as we come out of the rate hike environment, and more likely than not over the next 6 months we'll go into a world where interest rates are falling. So it's been an epic journey for those of you who started with us in December 2021. I can only say extend my apologies for launching this portfolio in Jan 22 with the PE and the post-COVID euphoria at its peak. But the good news is the dark days seem to be behind us. We've come out of the darkness, and the portfolio compounding this year, as Pramod was saying, we're up 17% in the 3 or the 10 weeks that we have seen in FY25. So how did that turnaround come about? Let's turn to the architect of the turnaround, Ashwin Shetty.
Thanks, Saurabh. Thanks, Pramod. So I'll just beam up the presentation. So this is the chart which depicts what Saurabh was talking about. So there are two completely different stock time periods here. So on the left-hand side, you'll see that the portfolio, as Saurabh said, launched towards late 2021. The first 15 months was very painful. The portfolio returns were down 20%. However, since the last 15 months, we have seen a very smart recovery in the portfolio to the extent that we are almost neutral. We have been able to make up for the loss of returns in the first 15 months. However, in the first 15 months, while the portfolio returns was going down, however, the silver lining was that the earnings, as you can see in this gray bars, the earnings actually was holding up, even though it was decelerating. So which means that the key reason for the portfolio returns going south in the first 15 months was the PE rating. So I will talk about it in the next slide. But one positive things which we'll notice here that the gray bars have been consistently positive, albeit it's moderating in certain quarters. But the earnings of the portfolio paints a completely different picture than what is painted by the return performance of the portfolio. We had some setbacks in the first half of this fiscal year FY24. Sorry, last fiscal year FY24. But we are seeing the earnings recovery as we move ahead. So in a nutshell, we expect this momentum that we are seeing in both returns as well as earnings in the last few quarters, that should continue. We are trying our best to continue that momentum, and we are also confident that that momentum will sustain as we go forward. Now talking a little bit in depth about what impacted the portfolio earnings in the first 15 months is simply this red line going down from 49.1, which was the 1-year forward price to earnings multiple of the portfolio when we launched. That went straight away down to 36, which is almost a 25% downgrade in the PE earnings. So this not only this actually more than offset the earnings growth that was demonstrated by the portfolio, and hence we saw the negative returns in the first 15 months. Now there are two things, I think the two theories which led to the portfolio derating. One is, of course, in hindsight, some of the stocks we bought initially in the portfolio, we bought it at high price to earnings, maybe for some of the cases at the peak valuation multiples. So in hindsight, so of course we could have done better in terms of timing the entry of those stocks. But also I think broadly there was some market was deviating from growth-oriented stocks towards the value-oriented stocks. I think many of you must be aware. So both the things meant that the portfolio saw a sharp derating in the first 15 months. Now the good news is that the portfolio, the PE multiple of the portfolio seems to be stabilizing. In fact, we are seeing a move upward. So it is re-rated by about 10% or so in the last 15 months. So hence PE, which played a spoil sport in the first 15 months, that doesn't seem to be a factor anymore. In fact, it is positively contributing to returns as we speak. Hopefully it will go up, continue to go up. But yeah, we had to endure that first 15 months of a PD rating on the portfolio. But here also, I think the things are looking up. So hopefully this P re-rating momentum will continue or at least stabilize at this level. Having said that, we have also made portfolio corrections, as Saurabh was talking about, in the last 12 months. I think one drawback of the portfolio is that it was heavily leaning towards a couple of themes, namely the first two themes highlighted here, the first two columns, that was China plus one. Hence, we had a lot of exposure to chemical companies and so on. And second was the financialization theme. So what we've done in the last 12 months is that deliberately bring in more themes in the portfolio, diversify beyond just two themes, getting into more themes like rural, private capex, healthcare consumption, and so on. So as a result, the portfolio, which used to have only 15 stocks, say 12 months back, now we are almost 25 stocks and in the portfolio. And most of the new additions have happened in these new themes. So we have made the portfolio correction, brought in more diversity, more themes in the portfolio. So you want to take us to some of these themes?
Yeah, I think Arshad's making a fair point. Again, back in 2020 and 2021, if you look back at those two COVID riddled years, right? Remember the first wave of COVID was 2020 and the second wave of COVID was 2021. In those 2 years, companies like, say, Page Industries, as all of us bought loungewear, and alkyl amines as we bought acetonitrile from alkyl, given that acetonitrile from China wasn't coming due to COVID-related logistics issues. Divi's Lab, because it was making molnupiravir for Merck. In those 2 years, calendar 2020 and calendar 2021, these companies did very well. Now, unfortunately, those 2 years, 2020 and 2021, RG did not exist. And to our discredit, when we set up RG in the closing months of 21, the opening months of 2022, we did not take into account that COVID was going to go away, right? In retrospect, that was a mistake, that not to take into account that COVID was going to go away. Had we been clearer in our heads that the second wave of COVID is gone, there's not going to be a third wave, we would have realized that Page, Alkyl, Divi's have massive earnings derating ahead of them. And obviously, if earnings growth goes like this and then it goes down like that, you'll also get a P derating, right? So we got a double whammy on stocks like Page, Divi's, Alkyl, who are massive beneficiaries of the two waves of COVID. We got a double whammy. EPS growth slowed down and the PE multiple corrected as people realized, and these companies were pretty candid in saying there is no third wave of COVID, right? But allied to that mistake was our excessive focus on specialty chemicals and financials. And as COVID ended, not only did specialty chemicals suffer due to COVID ending, specialty chemicals then got another whacking in FY24 from Chinese dumping, right? So specialty chemicals, you could argue, got two hammerings. Pehla to COVID ended, and second was as COVID ended, China dumped chemicals on the rest of the world, and Divi's to a certain extent, alkyl significantly so, GMM suffered enormously. So therefore, as we came out of F23, as we entered F24, Ashwin and the team put in a lot of effort to diversify the portfolio out, right? We are human beings. We make mistakes. Maybe in the world of AI, Ashwin, if you and I are replaced by AI, maybe AI will make fewer mistakes. But until such time, we're human beings, we make mistakes. But what we can do is learn from those mistakes and not repeat them. And hence, so through F22, the portfolio diversification was built out. And as you can see on the screen, these are very distinct themes. A rural theme around Eicher and Godrej Agrovet is very different from a premium consumption theme around Metro, around Trent, around Astral and Page. That in turn is very different from a private capex theme built around companies like SKF, Tube Investments, right? Lending in turn is a different theme, and the whole China plus one play, which is still probably the largest component of the portfolio. The China plus one play is not just around spec chem and pharma. The first three names are spec chem and pharma. The China plus one plays also around engineering. The last three names in that China plus one column. So we live and learn, and what we learned was have high quality stocks, the standard Marcellus principles, clean accounts, good capital allocation, dominant franchises, but diversify those high quality stocks across 5 or 6 sectors, so that if one sector gets stuck in a macro headwind, you don't end up losing 20-30% of your portfolio value. Right? That was the mistake we made first year round. We've corrected it, and the benefits there are there for our clients to see. Going forward, this diversified portfolio should be able to compound earnings at around the low 20s. And if we don't get a further PED rating, we should be able to compound comfortably at the low 20s. If a PE re-rating, and I should just go back one slide. It's interesting to see that the PE re-rating has already begun. I won't be able to give you any science behind it, why the PE has re-rated in the last few months. I won't be able to give you any science behind it. Maybe it's got something to do with the elections. Maybe the euphoria around PSU stocks has abated. Whatever the reason, if that 36.2, which is now gone to 40, if that goes higher, then you and I get more than the earnings compounding. Provided it broadly stays between 35 and 40, you and I should be able to get low 20s compounding on this going forward. Back to you, Ashwin.
Yeah, right. So question whether the portfolio changes that we have made, is this contributing to the portfolio return? The answer is the data shows that it's overwhelmingly yes. So these are the all additions. So we have made 12 new additions in the portfolio in the last 12 months. So when you look at the average returns of these stocks since their entry in the portfolio till 14 June, that was Friday, you'll find that on an average, these additions have contributed 31% to the portfolio returns. But more importantly, these companies, this returns is also backed by the strong earnings growth of these portfolio companies. So yes, so whatever additions we have made in the last 12 months, they have contributed positively to the portfolio returns. And it's also broad based. So we have shown median here. So it's not that we have got lucky with one or two or three stocks. So the median also suggests that the new additions broadly have contributed to the portfolio returns as well as to the earnings growth. So we seem to be in the right direction. We will continue to monitor the portfolio themes, whether they are playing out as per our expectation very closely.
And folks, I would suggest we focus on the last column of this table. This last column, the final column, is I think more important than the share price wala column. The share price piece wo upar jayega, niche aayega, that's somewhat beyond our control. But if you're able to build a portfolio where earnings are compounding at 25-30%, which is what we seem to have been able to do, that bodes well for our clients and for those who like this style of clean, high quality investing.
Yeah. And now talking specifically about this stock additions. So most of the stocks we had covered in our the first 10 names we had covered in our April webinar. We added two more stocks in the last 2 months. That is Godrej Agrovet and Polymedicare. Going into little bit details of these individual stocks. So Godrej Agrovet is a company which has been listed for around 8-9 years now.
Ashwin, you might want to move forward. The slide hasn't changed.
Oh, sorry.
Thank you. Yeah.
Okay. So the Godrej Agrovet is a company which has been in existence for almost more than 30 years, but been listed for around 8-9 years now. The company exactly didn't have a very great track record of earnings in the last 5 to 6 years. I think a couple of factors which impacted the company's earnings. One is through COVID and post-COVID, we have seen a lot of volatility in the commodity prices. And that has impacted the input prices for most of the divisions of Godrej Agrovet. For example, animal feed, soya prices is a key input in the animal feed division of the company. Soya prices have seen a high degree of volatility in the last few years. Similarly, the milk prices, which is the input for the milk, basically the milk prices, which is actually the finished good prices for the dairy business, that has also seen a lot of volatility. Through COVID and post-COVID. So the company has clearly suffered because of this heavy volatility that we have seen in the commodity prices in the last few years. There is also some the crop protection. Their subsidiary Aztec also suffered because of the Chinese dumping. So Aztec historically derived nearly almost all of its revenues from the enterprises product from the global markets, and we have seen very heavy Chinese dumping in those products. And as a result, Aztec, which was a healthy profit-making company until 2 years back, has gone into red in the last 12 to 18 months. But as we move forward, we are seeing things improving for the company. One is that we are seeing the commodity prices stabilizing in the last 12 months. So that is one positive sign. Secondly, the companies also made a lot of internal changes. For example, historically, most of its divisions were commodity in nature. Basically, but in the last 3 to 4 years, there is a lot of focus towards value-added products, which these products actually exhibit a high degree of resilience. The pricing power is higher in these segments, and hence they are able to perform better in a volatile commodity market. Just to give you some example, for example, in the crude palm oil division, the company was historically selling only crude palm oil. But in the last 12 months, it has put up a refinery, and hence it is now selling the finished edible oils. Similarly, in the Aztec division, the company has pivoted towards CDMO business. So from being off-the-shelf enterprise products, now in the last 2 quarters, most of its revenues is coming from the CDMO business, where there is a resilient, basically the margins and the pricing remains fairly stable in this business. Similarly, in the dairy business, now almost 40% of their revenues come from the value-added products like butter, butter, ice cream, and so on. Where again, it is not so much impacted by the movement in the milk prices and so on. So hence, we are seeing a company being much better than what it was 3 years back, and hence it is much better placed to face the volatility in the commodity prices, if at all it comes in the future. We're also seeing company benefiting from the government policies. For example, palm oil. India is a very big importer of palm oil. But the domestic production of palm oil is just about 1/10 of what is getting imported. So clearly, there is a government thrust towards having more and more palm oil plantation in India. And hence, around 3 years back, the government came up with a policy on National Mission on Edible Oils, oil palm, where the government is promising kind of a MSP-like promise to the palm oil cultivators. And thanks to this policy, we are seeing historically, whenever the palm oil prices used to be high, there used to be a lot of cultivation. But when the palm oil prices went south, the cultivator used to remove this plantation, and hence the area under cultivation for companies like Godrej Agrovet used to see a lot of movement. But since the last 3 years, and with this MSP type pricing coming into picture, we are seeing continuous linear increase in the cultivation of oil palm in India. And the opportunity, as a highlight, the 90% of the palm oil in India is imported. So there is a sea of opportunity for the growth of palm oil sector in India. And clearly, Godrej Agrovet is the leader in this segment. It accounts for nearly 1/3 of the total palm oil.
Just to supplement what Ashwin is saying there, our sources in Andhra suggest that the new Chandrababu Naidu government sees this whole industry, this whole commercial cultivation of palm oil. Chandrababu Naidu government sees this very positively, and our sources suggest that we will see significant growth in the acreage that Godrej Agrovet has in Andhra. Andhra and Telangana are the two critical states from a palm oil perspective, and it seems that there will be significant growth in acreage in the years to come in Godrej Agrovet's area under cultivation in Andhra Pradesh. And equally importantly, I think, is a political heavyweight like Shivraj Singh Chauhan ji becoming the Agri Minister in Delhi. Those of you who've been following Shivraj Singh Chauhan's career in MP would know he's a legendary agri reformer. He took MP, I think, from a laggard state. I think MP was ranked around 12th in national agri production 20 years ago. And Ashwin, it's now ranked number 2 or 3, right, in the country?
Top 3, yeah.
Top 3 in the country. So that was Shivraj Singh Chauhan's doing. So he's a known, effective reformer of agri, and him at the helm and the center has, I think, positive connotations both for Godrej's palm oil business, vegetable oil business, which is 1/3 of their profits, but also for their crop protection business, which again our channel checks suggest is going great guns. Allied to that is again coming back to South India, Telangana, Andhra. They have a flourishing milkshake, curd production business called Jersey. The brand is Jersey. And that Jersey brand also seems to have done well last year. Last year, we saw significant improvements in margins for Godrej's milk business. This year, it seems margin improvement would potentially be also allied to volume growth. And the final aspect of the business around animal feed. This is animal feed for cows, for fish, and for shrimp. The shrimp feed piece is a challenge because in shrimp, these guys are not the market leader that honor belongs to Thai Union. But in cow feed and in cattle feed and in fish feed, both of which are booming businesses, these guys have leadership positions in North India, in Western India and North India, respectively. So you have a business here with high ROCs. You have a business here with high ROCs, a franchise which has grown top line at a decent clip, I think double digits over the last 5 years, but earnings growth has been a modest 2%. There's efficiency improvements that they need to deliver. FY24 was encouraging. We think there's more to come in FY25. Then there is reform at both the state level, at the Andhra state level, and at the national level that they could benefit from agri reform. And thirdly, improving the product lineup to have more value-added products. We think the current market cap around 1.4, 1.5 billion can easily double in the next 3 years. Just to put it in perspective, this company and SRF both have broadly the same top line, 10,000 crore ke aaspaas. SRF's market cap is 7x that of Godrej. So it gives you a sense of how much potential there is. This is a well-run franchise, profitable, high ROCE, but there's so much more that can be done here. And if we get agri reform firing, if we get the efficiency improvements coming through, I think our clients here will benefit from Godrej Agrovet mightily over the next 3 years.
And the second stock which we added is Poly Medicure. Again, unlike Godrej Agrovet, this company has had a very, very blazing earnings and very consistent one through the last 10, 15, 20 years. So Poly Medicure is the largest exporter of the disposable plastic consumables like IV cannula, three-way stopcock, and unlike many of the Indian companies, which started from the domestic market and then moved to export market, Poly Medicure took a bold step of focusing on the export markets, because there were already players present in the domestic market when they started 3 decades back. And they have had a very good run in the export market. Primarily through offering good quality products at much cheaper prices than the regional players or the global players in the export markets. So this first focused on the emerging markets, where of course there is a leaning towards getting value products. So for example, Brazil is one of the first market, and till date continues to be a very important market for Poly Medicure. And after getting success in the emerging economies, they plowed back much of these profits back into the business, worked on the R&D, worked on bringing automation and quality in their plants. And in the last 5 to 6 years, they also have had success in the tough, the developed markets like Europe. We, even after I think growing north of 20% in the export market for the last 20, 25 years, when you look at the overall market, it is still, I would say it's in low single digit market share. So there is a huge opportunity still awaiting for Poly Medicure, and we are very confident that as they continue to reinvest into the business, expand their line of products and so on, they will continue to gain market share in the export markets, and that will continue to contribute handsomely to the earnings growth. What has happened also in the last 5 to 6 years, they have also replicated their exports strategy in the domestic market. They were practically absent from the domestic markets around 7, 8 years back. But they also started targeting the MNC imports, which is happening in the domestic markets. Again, same philosophy of offering good quality products at a much cheaper prices than what the MNCs offer. And we have seen their domestic business also clocking healthy growth rates in the last 7, 8 years. And again, here, similar to exports, we believe that there is a still large addressable market which they can address over the course of next 5 to 10 years. 10 years, and that should contribute to the earnings growth. So Poly Medicure is a recent entry. We bought it around 1.5 months back, and this is the most recent entrant in the Rising Giants portfolio. And moving to finally, there are some stocks, all the good things we talked about, but there are some stocks which are yet to see meaningful recovery in both the earnings as well as the returns in the portfolio. The list was actually a little longer in the April, so happy that it's now just restricted to 2 companies. So Alkyl Amines and GMF Pfaudler, amongst the first stocks that we started the portfolio with. They clearly struggled through their existence in the portfolio. But why we continue to hold both these companies? Why we continue to hold both these companies in the portfolio is Alkyl Amines, again, a very strong track record of top line as well as bottom line earnings growth. COVID actually created a lot of volatility in the earnings of the company. So on one hand, in FY21, clearly Alkyl benefited, as we had discussed before also, both from the volumes, because for example, one of the key products called acetonitrile it found an application in COVID-related drugs. On the other hand, China was virtually shut from the global supply chain during COVID. And as a result, not only the volumes of alkyl rocketed, but also the price of acetonitrile rocketed. So, and hence, a company which used to make 18-20% margin on an average, its margin doubled during COVID period. But what we have seen in the last, since the end of the COVID, is that whole acetonitrile pricing unwinding. While things started stabilizing in FY23, as Saurabh said, what has led to the pain in FY24 is China coming back with a vengeance in the global supply chain in the last 12 months. So clearly, acetonitrile prices, which used to be 200 rupees per kg pre-COVID, which jumped to 400 rupees during COVID. That should have ideally come back to 200 rupees, but because of this China dumping, this price of acetonitrile went all the way down to 110 rupees per kg. And that has created a lot of pain for alkyl, especially in FY24. However, as we speak today, what we are seeing from the export data.
If you don't mind, I'll beam up the acetonitrile prices.
Okay.
Yeah, I'll just beam it up. So I'll just take over the sharing. So folks, this is the piece that so alkyl, as I said, double whammy. Firstly, COVID ends, and therefore the demand for acetonitrile abates. Yes. So COVID ends, and the demand for acetonitrile abates. And then the second piece was in F24, China begins the dumping. So if you see the bottom, yeah, here we go. Here you can see, right? This is India Mart. This is a straightforward way to assess India में acetonitrile prices का क्या हुआ, right? So as luck would have it, we launched this portfolio somewhere here. And we benefited for a few months, and then last F24 year to March 24, you had this colossal drop, right? 210 rupees से 160 rupees हो गया है. Many people in India, not just alkyl, many other people who wholesale acetonitrile, as you can see on India Mart, there are numerous distributors of acetonitrile. They've used that the cost at which China is selling acetonitrile in India is below the cost of production, and hence alkyl has gone to the government with an anti-dumping complaint. We understand from various sources that complaint is under investigation. If relief comes, if the government of India imposes anti-dumping duties on imported acetonitrile from China, then basically that's a 30% jump in alkyl's profits, right? So there's nothing wrong with the company, debt-free, well-run, dominant franchise in aliphatic amines, the largest producer of acetonitrile in India. We can't expect them to sell below cost. Thankfully, they're not selling below cost. That would have been a disaster that perhaps Ashwin and I couldn't deal with if alkyl started selling acetonitrile below cost. They're doing the sensible thing. Now, given that China is dumping, these guys have throttled off. They've throttled off on acetonitrile and gone to the government. If they get relief in the coming weeks from the government of India, we should expect to see that blue bar in F24, which is down 30, that will at least go back to neutrality. Back to you, Ashwin.
Yeah. So basically, there are three pieces to alkyl. One is methylamines, second is ethylamines, and third is the acetonitrile-based acetonitrile. These three are the largest contributing products to alkyl. I think the first two are doing fine. I think methylamines, for example, it's a very difficult product to transport, and hence import of this product has historically been very, very low. It's a very hazardous product. So it's all domestic supply and domestic demand. So methylamines is doing fine. Ethylamines again is doing fine because it's a very difficult product to make. It requires a lot of, it's a capex intensive product, and hence China has not been historically a very big player in ethylamines. Acetonitrile is where China has a dominant presence, and that is where the pain is. And as Saurabh said, if there is some favorable outcome on acetonitrile in anti-dumping investigation, I think we will clearly see the profits turning around significantly for the company in the years to come. So that is where we hold alkyl amines. So we had definitely cut down the position from what we started, but we still continue to hold the stock. GMM, more or less similar to alkyl amines story. The company has historically done very, very well, market leader in the glass line equipment. It continued to do well even post-COVID. I think one important capital allocation which they made was acquiring that parent. In hindsight, that decision turned out to be very good. So they were clearly able to turn around the margin of the Fowler international business from what used to be mid-single-digit EBITDA margin to double-digit early teens margin. So that contributed enormously to profit growth, especially in FY23. However, things have caught up for GMF Fowler, the broader slowdown in the chemical space, and hence delaying or deferment of the capex being done by the chemical companies. That has clearly caught up with GMF Fowler in FY24. So clearly, the glass-line volumes, and with volumes also the pricing, and hence the impact on the margins. Everything as a negative has come together for GMF Fowler in FY24, and hence after a long time, we saw muted earnings growth. Almost 7-8 years after 7-8 years, we saw a very muted growth trend for GMF Fowler. This FY22 is actually a one-off actually, so it was actually a good number. So FY24 is we saw muted trends for GMF Fowler. However, the silver lining is that GMM, by virtue of acquisitions, glass-line equipment used to contribute dominant part of its revenues and profits, say 5 years back. But through various acquisition, GLE's salience has come down to around 50%. The non-GLE segment like mixing, heavy engineering, they are firing for GMF Fowler. And hence, unlike alkyl, where the profit clearly declined, GMM still, the profit has stayed afloat on the positive side in FY24. So here also we believe that as I think chemical prices stabilize, etc., the chemical companies will start on the capex journey, and that should clearly help GMF Fowler. And similarly, there's a lot of opportunity in new segment like mixing systems, where GMM has done a lot of investments. It has also hired good people in that businesses. And globally, mixing is a much bigger business than the glass-line equipment. So if GMM is able to build over the years a dominance in the mixing systems, I think that should also help the revenue and the profit growth in the coming year. So we continue to hold, albeit at a lower position than what we started with in both these stocks. And finally, how we see the portfolio, summing this up, we are expecting the portfolio earnings, which has been bouncing back in the recent quarters, so that momentum to continue. And as Saurabh said, I think one of the biggest factors is the kind of reinvestment made by the portfolio companies in the last 3 years. So just to put some numbers, the average or the reinvestment made by the companies in the last 3 years is double than what these companies invested in the preceding 3 years, that is FY19 to 21. While the demand environment for some of these companies is currently weak, as we highlighted, but whenever things normalize, these companies already have capacities in place, and hence they should benefit disproportionately from the demand recovery. And not only earnings, the free cash flow growth, again, because these companies don't need to now invest as much as what they did in the last 3 years. The free cash flow growth should be much better than the earnings growth. Yeah, and some of the portfolio companies which are not firing, we discussed a couple of them. We are expecting them to have a much better time in FY25 than what it has been the last 1-2 years. And finally, as you must have seen, the first 2 quarters for the Rising Giants portfolio from earnings perspective was weak. So in FY25, we should also have a favorable base effect. For example, if you look at the long-term trajectory, earnings trajectory of these companies, it would be easily 20%.
I should just go back to that original, the first slide, and then it'll become easier for people to understand.
So historically, Rising Giants companies, even our past Rising Giant portfolio companies, even the current set of stocks that we have in the portfolio, they, from a 5-year perspective, 10-year perspective, 15-year perspective, they have been growing their earnings at 20% plus. But because of the headwinds that we highlighted, this year the growth for the portfolio for the full year was 14%. It was below the long-term average mark. But on a positive side, the base is lower for FY25, and hence we should see that also favorably impact.
Basically, what Ashwin, you're saying is that since June 23 or September 23, earnings growth weak tha, since June and September 23 were weak. Therefore, H1 this year will be even more impressive than the 16% that we saw in the March 24 quarter.
That is that should positively contribute. Yeah, I think here is we will stop the presentation. We can open the floor for questions.
Pramod, do you want to moderate the Q&A?
Yeah, sure. So folks, please put in your questions in the Q&A box at the bottom of the screen. We already have a few questions. Take it top down. So the question around the Chinese exports and dumping, again, link it to the longer term China plus one strategy. A couple of our people asking the same question in various ways. Is China plus one real, or what we saw as the benefit in 21, 22 was simply because China was shut from the global supply chain? We sort of extrapolated that as not just us, everybody around who's talking about China plus one. Now it's not just China plus one. China has come back to the global supply chain, and that's hurting in several sectors where we haven't even invested, right? So electric cars, for example, the whole world is complaining about Chinese taking over. Do we see any evidence of companies that we're invested in?
Yeah, so Divi's Lab is a great example of a beneficiary, right? So you've seen, I'm sure those of you who are invested in CCP or an RG, you have seen Divi's posts solid earnings growth through F24, especially as the Molnupiravir base effect got cancelled out. Their third plant, Divi's plant 3, the third plant in 30 years, is filling up nicely on the basis of exactly China plus one, right? So the third plant is contrast media. Contrast media is the dye that you drink before an MRI. 90% of it comes, 90% of the world's contrast media comes from China. For obvious reasons, the Western countries are uneasy about that dependence on China, and hence they are turning to Divi's. Divi's is their most trusted. It's the largest API manufacturer in India, and other than giants like Lonza in Europe and Wuxi, which is the Chinese giant, and Chinese giant, which is now in the bad books of many of the Western companies. Other than Lonza and Wuxi, Divi's is the world's most credible manufacturer of APIs and outsourced medicines. So you can see Divi's is plant 3 filling up nicely. I reckon Divi's will have a blockbuster F25 after a solid F24. So what is the moral of the story? The moral of the story is if you can make a product which takes commodities from China. What is Divi's doing? Divi's is taking key starter materials. It's called KSM. Divi's is taking KSMs cheap from China. China is selling everything cheap, so KSMs have dropped in price. Divi's is taking the KSMs cheap from China, processing it, turning it into APIs or into finished drugs for Merck, for Pfizer, for Glaxo, and selling those 80-90% of Divi's shipments go to the Western world, right? Similarly, in our Little Champs portfolio, we have a company called Ami Organics, which is making intermediates. So API ke one level niche is intermediates. Intermediates goes into the API. Ami supplies APIs. Ami supplies intermediates to Divi's. Ami also supplies intermediates to European pharma companies, and that company to Ami too is seeing an improvement in its business through F24. So in sectors like pharmaceuticals, like mobile phones, like cars, where the imperative for the West to reduce dependence on China is intense. It doesn't matter that China makes cheaper iPhones than India. Clearly, Apple has made up its mind that cost can go to hell. We need to reduce our dependence to China. And as you would have been reading in the newspapers, from making $2 billion of iPhones 2 years ago, we now make $22 billion of iPhones now. And I think that number will only grow as Apple reduces its dependence on China. Similarly, in pharmaceuticals, Divi's is in pole position to benefit from the kind of radical desire of the Western world to reduce its dependence on China. In fact, in both of these sectors, the problem is not that China is dumping. I think that's the least of our issues. The problem is India's production capacity is modest, tiny compared to China. So let's take API. API का global market would be 120, 130 billion. We make $7, $8 billion. China makes $100 billion. So even if we take 10% of Chinese production, our industry doubles in the next 3 years. Question is, other than Divi's, I don't see too many other API companies being in a position to ramp up capacity at that speed. Divi's thankfully is growing capacity at a rapid rate. As we speak, plant 3 is being expanded. From what I understand, they're trying to buy land for plant 4, but there are not that many API companies in India with this sort of financial muscle to ramp capacity at the speed, and the West's need to reduce dependence on China is intense, right? Similarly, smartphones, pads would be a $400 billion ka industry. After huffing and puffing for 2 years and PLI and all that jazz, we've got to 20, 30 billion. But that's less than 10% of global production. And China makes, I think, $250 billion worth of this stuff. So even again, if you again take 10% of the Chinese production, our smartphone industry will double. But it's not evident to me that we have the ability to ramp production in India at that rate. So the issue around China plus one is not that we're not getting the business, we are getting the business. The issue is China is 10x larger than us in everything. And even if we get 10% share, we get big jumps in our economy, buying land in India, buying industrial land in India, hiring skilled labor. These are not easy things. And that's where the operational challenges lie. The clear lesson for us, I think, for Marcellus is a China plus one is working, it will work. What we cannot afford to do is invest in commodity companies, companies who are making a straightforward product, acetonitrile being an example, right? Alkyl amines is selling acetonitrile. It's the cheapest producer locally. It's the largest producer locally. But China is selling acetonitrile below cost because they can and they don't have any other source of demand. So they're dumping it all across the world. So I think that's the lesson we have learned. Don't mess around with commodity companies. Because if you do that, China will come and bang up that commodity company, and I'm not so sure. I'm not so sure how much protection the Indian government will offer on a consistent basis. Hopefully, in Alkyl's case, the government will come to their rescue. But at one level, the Indian government is also quite savvy. Their point is China wants to sell sasta below cost. If the Chinese want to sell a commodity below cost, then let them do so. We benefit as a nation. So as long as we keep our wits about ourselves and invest in companies that take the raw commodity, which might come from China, and add value to it, we'll make money. So take another example in our portfolio. Take Astral Poly. Astral Poly is taking Chinese polymer, right? He's buying some from Reliance, but I suspect he's buying some polymer from China as well. The world is awash with Chinese polymer. Anything to do with plastic polymer, China is flooding the world at below cost. So if you're a commodity converter like Astral Poly, this is like heaven. You're getting cheap polymer. You're molding that into a pipe, and we've got a construction boom underway in India. And Astral Poly, Supreme Industries, these companies are benefiting mightily. Similarly, on Asian Paints, you can see Asian Paints' earnings growth. I think was 25 or 30% earnings growth last year. Again, it's a commodity converter. It's buying petrochemicals. Petrochemicals prices I suspect will fall even further as the Chinese economy keeps ratcheting down. So companies in little champs mold tech packaging, right? Again, commodity converter, polymer खरीद के आप plastic का डब्बा बना रहे हो. So as long as you invest in a company which adds value to a commodity, you're in good shape. If you invest in a commodity company, you invest in metals mining, I think problem हो सकता है, given that Chinese economy seems to be falling into a never-ending, black hole.
Fair enough. The other theme is private sector capex. Clearly, we got exposure through stocks like RHM, Agnesida, and all. Seems like the private sector capex has been elusive so far. Any sense on what stage of the cycle we are in? What do we expect going forward? And how is the portfolio geared towards it?
So I think Ashwin, just go to that capex chart, wala hamara RG ka capex chart. So what we're seeing, Pramod, is across our portfolios. Ashwin's got the chart here for RG, but a very similar picture in CCP, in LCP, right? Because we as Marcellus, we have not this chart, Ashwin, वो वाला chart यार, जहाँ पे दिखा रहा है हमारे investing companies कितना capex कर रहे हैं, not the theme वाला, the final table. So because we as Marcellus invest in companies with high ROC, across our portfolios, we can do this table. So ये table RG के लिए है, but the same table applies to CCP, the same table applies to LCP, to curation. And Marcellus companies are doing daba ke capex, and the benefits are there to see. RGP companies, the earnings growth is picking up nicely. CCP, dramatic improvement in earnings growth in F25 and F24, and even a little champs the last couple of quarters earnings growth is coming through. So that if you do capex, you benefit, right? The challenge for most Indian companies, Pramod, the challenge for most Indian private sector companies is they don't have these sorts of ROCs. You need ROC well above cost of capital. You need ROC at least 20%, ideally 30%, to generate surplus capital, which you can reinvest back in, right? Most of our companies, PSU or indeed otherwise, don't have that sort of spare capital, and hence their ability to reinvest is modest. What's compounding their problem is the consumption slowdown in India, right? If as it is, आपका ROC modest है, and hence you're struggling for equity capital, and you're seeing the GDP growth prints coming in with 2% consumption growth, which means at a per capita level, which means at a per capita level, consumption growth in India is zero. Then the promoter will say, "Am I mad to be doing heavy duty capex given that consumption growth is at its weakest in 20 years and my ROC anyway is low?" So that's where I think the problem lies. The problem lies partly in that India has too many companies with weak return on capital, and partly in the fact that due to a combination of circumstances in the post-COVID world, consumption, especially for the lower half of the population, the weaker, the 20% poorer, the 50% of the population, which is the poorer half of the population, consumption has fallen off a cliff for them. The panacea, the remedy is if the government revives consumption, and all the announcements that the new government has made in the last 8-9 days suggest they are deeply focused on reviving consumption. Announcements such as tripling PM Awas, increasing the Kisan Samriddhi, doubling the Ayushman Bharat insurance payout. Those announcements seem to suggest a big focus on the government's part on juicing up consumption for the bottom 50% of the country's population. If that happens, I think we will see more capex. If that doesn't happen, we'll only see these sorts of RG, LCP, CCP type of strong franchises with great rookies, doubling, trebling capacity, and grabbing more market share in India.
Great, thank you. Now, this is a question we are often asked in terms of valuation, where the gentleman who's asking the question is saying that, look, there's never a question on the fundamentals of your companies. Yes, earnings growth has slowed down, but entry point valuations were high, and hence the drawdown becomes sharper inevitably. Is there any change in the way we look at valuations of companies compared to how we used to look at, say, 2 years ago at the time of launch?
So there's two aspects to this, right? So at the stock level, as you can see, folks, if you can see names like Trent and Tube, we clearly don't hesitate to buy great franchises, even if they look optically expensive. When we first bought Trent in July last year, it was, I think, what everybody thought it was at 140 PE. Our math suggested Trent was actually at 45 PE. So whilst the whole country was aghast that boss kaise le sakte ho 150 PE ka stock, we did the work and we figured out Trent was actually quite cheap. And only in recent months, when after Trent has tripled on us, that we've reduced the position somewhat. Similarly, a Tube investment, a lot of people optically look at the optical PE and they get very stressed. We've done the work on it. We believe Tube is actually a bargain given the number of strongly firing businesses that are inside Tube. CG Power, Shanti Gears, Tube's core engineering business, the 4 EV businesses, the 4 electric vehicle businesses inside Tube. So this whole obsession ki boss PE dekho aur uske baad invest karo, we don't have any time for that point of view. I don't think you can make money looking at PE multiples and saying that gives you some sort of signal on how much money you can make from a business. That being said, what we have become more conscious of is if the denominator of the PE multiple, is inflated, and you get in at what is actually a peak E, and thus the E then comes off. The E comes off after your investment, then you get into deep trouble. So the way to think about the PE is it's not the numerator which matters, it's the denominator which matters more. And had I spoken to you 4 years ago, if you'd asked me 4 years ago, can underwear companies have cyclical E? I would have said, nahi, ho hi nahi sakta. But having lived through how Page Industries' earnings went through the roof during COVID and then came off sharply thereafter, if you'd asked me, can a path lab company like Dr. Lal's have cyclical earnings? I would have said, ho hi nahi sakta. But again, having lived through how Dr. Lal's earnings rocketed through COVID and then plateaued for 18 months thereafter, I'm wiser for that experience. Had I met you 4 years ago and you'd asked me, can pharma companies have cyclical earnings? I would have said, no, nahi ho sakta. And then I saw Divi's lab go through rocketing P through Molnupiravir. And then as Molnupiravir came off, earnings growth turned from plus 30, 40 to minus 40. So that piece, right? Understanding, spending time, researching, thinking through is, am I coming in at peak E rather than peak P? The peak P, I think, is the wrong question to ask. Am I coming in at E, which is likely to conk off, I think is the more relevant question to ask. We've learned that lesson the hard way. That you need to spend some time figuring out whether are you coming in at peak E. So if you take this portfolio, right, if you look across that portfolio, our research suggests we are not coming in at peak E. So let's go back again to the most expensive stocks optically in this portfolio. They would be Trent and Tube. In both cases, we've got very good visibility on rapid earnings growth. In Trent's case, through the doubling of Zudio's floor space every year. Zudio, as you would have heard from Rakshit and from Trent's management, Zudio is opening 200 new dukaan every year. Every day they're opening basically a new 20,000 square feet ka dukaan. West Side is doing reasonably well, but Zudio and Star Bazaar has got 60 stores, but we think profitability, they're going to go from loss to profit. And management has given good guidance on ramp in Star Bazaar stores. So where you can see that in a Trend's case, earnings growth will be very strong. In a Tube's case, you can see earnings growth will be, say, in the vicinity of 30% for many years to come. You don't spend that time agonizing about the numerator. You focus on the fact that you have strong visibility on rapid compounding in the denominator. So in PE, the denominator matters more. The numerator is the piece that you need to think of as a function, as an outcome. The denominator is the main job of the fund manager to focus on. And if you have strong visibility on rapid denominator growth in the PE multiple, you get in and compound. That was our mistake that we made in early 2022, not focusing enough on agonizing about the EPS growth aspect of companies like Alkyl, like Divi's, like Page. And we paid the price for that. Our clients paid the price for that, unfortunately, through that 20% drawdown. But as I said, you live and learn. We've learned our lesson, and hopefully the investments we are making will have the capex that Ashwin has highlighted on the screen. Hopefully that portends rapid growth in earnings over the next 2 to 3 years.
Just as a corollary of that, in terms of companies seeing earnings decline continuously, I know we've sort of corrected the position size on Alkyl and GMM. Why do we continue to hold it? Why not come back when the earnings momentum picks up again, than just cut the position and stick to weak earnings momentum stocks?
So let's take it one by one. Let's take on Alkyl. Alkyl is an event-based thing here. The underlying business is actually fine. Their aliphatic amines plants are running at high levels of utilization. Volumes, revenues actually are in decent shape there. And the main competitor, Balaji, who our analysis suggests is potentially less efficient than them, I think has scaled back. In acetonitrile, which is a third of their profits, that third has become a zero. And that third is contingent on the government announcing the anti-dumping measures. Promote the day the government announces that anti-dumping measure, the stock will go up broadly a third. And I don't think Ashwin and I are clever enough to figure out which day that announcement will be. If we did, we could have sold it the day before the government makes the anti-dumping announcement. We could have bought it. Unfortunately, we don't have that sort of visibility, and hence we are waiting for the relevant regulatory measure to come through. In GMM's case, in a way, it's linked to the China story. China, as I'm sure all of you are reading, every week we're getting bad macro news in China. What the bad macro news in China is doing is it's resulting in China dumping more, both in Europe and in India. That in turn is making the chemical companies and the especially the agrochemical companies and the specialty chemical companies reluctant to do more capex, right? It's understandable. If you're a agrochemical company and China is dumping in your country below cost, you're not going to be running to GMM to get a new reactor going. So in GMM's case, the pullback is contingent on basically the European Union or the Indian government doing what happened in cars last week. For those of you who sort of missed it, the European Union announced a 40% import duty on Chinese cars last week, right? Chinese cars were destroying firms like Volkswagen and Stellantis through their high quality, low cost cars being sent from China to Europe. Why would you buy a Volkswagen for 40-50% more if you can get a perfectly good BYD to drive in the straight streets of Paris and Frankfurt? So we used to sit in the office and look at Volkswagen's plunging stock price and ask ourselves, when does this end? We used to look at Stellantis and say, this is a great company. This is a great company, but courtesy Chinese dumping, the share prices were a challenge. And naturally, therefore, as soon as the European Union became constructive, as soon as the European Union became constructive on Chinese dumping, the Volkswagen stock price or the Stellantis stock price started showing a recovery. Similar dynamic, Pramod, I think pertains to GMM Pfaudler. There's nothing wrong with the firm, efficient, well-run company. In spite of all of these challenges, EBITDA margin is 13-14%. I haven't seen too many large industrials companies who at the bottom of that cycle is able to do 13-14%. The product is high quality. We've had plenty of discussions with customers like Divi's on GMM's product. It's a high quality product. We need to be a little patient here on governments in Europe, in America, in India, doing the needful to protect their economies from China. And if they do that, for example, the import the dumping anti-dumping duties that we're talking about for alkyl, if those happen more generally, GMM Pfaudler will see a demand recovery. And similarly in European chemicals, if the European Union realizes that their chemical industry is going to be wiped out because of cheap Chinese imports, there'll be, much like in cars, there'll be import duties on Chinese chemicals as well. And that in turn drives the recovery in demand. So we've invested in companies which are efficient, well-run market leaders in their businesses. They cannot produce below cost, and hence they are suffering due to the Chinese dumping. Given the strategic importance of these industries, chemicals in Europe, chemicals in India, I don't think the Indian government will just sit back and allow these industries to be wiped out. India did this, by the way. This is how our chemical industry got wiped out through the 90s and noughties by the Chinese. I don't see India making the same mistake twice, and hence we are patiently waiting for intervention here. You have to learn to be patient in investing. We have to be learned to be patient. If you look at in both GMM and Alkyl's cases, folks, if you look at the first panel of Ashwin's chart, right, the left-hand side panel, right, if you look at the left-hand side panel in Ashwin's chart, you can see that there is no reason to be alarmed about their structural prospects. So pre-COVID, FY 15 to 20, Alkyl is a company compounding earnings at 30%. And pre-COVID, FY 15 to 20, GMM is a company compounding earnings at 30%. Both of these companies were consistent compounders pre-COVID. COVID created volatility in their business. Thankfully, we invested in these firms in August 19 before the mania kicked in. We made great amounts of money for the first 2 years, and then we have made no money. In fact, we've had a drawdown over the last couple of years. In investment, if you have 2 years of really good money and 2 years of modest returns, life teaches you to stay patient and hang in there, given that the fundamental franchise is healthy, as evidenced by that 15 to 20 numbers for both of these companies.
Fair enough. Last question on the portfolio. In terms of our take on cash positions, has there been any change in our thinking? Earlier, we didn't believe in taking cash calls, but now we're seeing frequently there are cash positions building up. Is there a change in thinking aligned to that? Allied to that is the thinking on position sizing. Are there any changes on those two aspects?
I think two aspects. I'll take the question on position sizing. Ashwin, if you could take the question on cash positions. On position sizing, what we are trying to do is broadly what we have done in the past, where we have great visibility on strong earnings growth and thus superior compounding. We're buying larger positions. How do we gauge earnings growth in the years to come? In simple terms, it's the ROC of the franchise multiplied by the reinvestment rate. So in any company, anywhere in the world, the simple way to understand how fast will earnings grow is, if, say, let's take Divi's Lab. If Divi's Lab's ROCE is 30% and 80-90% of that is getting reinvested, 80% of that is getting reinvested, there's a good chance that Divi's Lab will compound earnings at 24-25%. And therefore, if there aren't too many other stocks in our portfolio that will compound earnings at 24-25%, then we should give Divi's Lab a higher position size. That was what we historically did. That's what we still do. As I mentioned, what we are that much more vigilant about, having got beaten up in 2022, what we're that much more vigilant about is, are we getting that earnings projection over the next 3, 4, 5 years? Are we getting Divi's FY 24 to 29 earnings projections in broadly the correct ballpark? We're not going to get it right to the sort of the decimal point, but if you're broadly in the correct ballpark, that if we expected Divi's to grow earnings at 25 and they grew earnings at 22, 23, that's all right. But if we expect Divi's to grow earnings at 25 and they end up growing earnings at 17, then that's a problem with our financial modeling. So the greater the confidence on strong EPS growth, the bigger the EPS growth number, the greater the position sizing. That philosophy was always there. It's still there, but just that there is greater diligence, greater care associated with getting the denominator forecasting right in that PE multiple piece. Ashwin, on cash positions.
On cash position, I would believe there is no fundamental change in our approach. Only thing is that there is a temporary phenomenon. So as Saurabh said, we are much more relentless now on for a stock has run up, example 50%, but there has been no commensurate increase or improvement in the fundamentals. So of course, its IRR that we expected has come down, right? So we are getting or trimming that position more proactively than what we used to do, say, a couple of years back, and hence that creates a cash position temporarily. But eventually we reinvest that in either the other portfolio companies where the IRR looks solid, or we get into the new stocks. For example, I think right now, last week, we have been trimming positions in few stocks. So you will find the cash position high, but by the month end, I'm confident that we'll down to the normal level. So it is more about a short-term phenomenon, I say. Nothing fundamentally changed in our approach.
Great. Thank you. Thanks, Saurabh. Thanks, Ashwin. And thanks to all our clients for bearing with us. Hopefully this recovery that we've seen over the last 3 months should sustain, given that we've corrected some of the mistakes of the past. The portfolio is very strongly positioned towards strong earnings growth, and that should carry forward the performance of the last 3 months well into the next 12 to 24 months. Thank you so much.
Thank you.
Thank you, everybody. Thanks, Bob. Thanks, Ashwin.